This is part 2 of the presentation for Module 3 for Accounting 311 Financial Statement Analysis for Global Entrepreneurs. In this learning objective, we will extend the return on equity analysis to include an operating focus by identifying balance sheet operating items and computing non-operating assets. Return on equity analysis with an operating focus recognizes that companies create value mainly through core operations of the business. Operating activities involve the manufacturing and selling of company products and services to customers. Non-operating activities involve non-strategic investments of cash into marketable securities and debt financing activities. The balance sheet and income statements include both operating and non-operating items. Because operating activities affect company value much more than non-operating activities, our analysis of a company can arguably be improved if we separately identify these two components of the business and analyze them separately. Return on equity computed using net income and total equity reflect a blend of the return on the company's operating activities and the return that arises from the non-operating activities. As the slide indicates, return on equity consists of the return from the company's operating activities linked to revenues and expenses from the company's sale of products or services and return from financing and investing non-operating activities. Companies can use debt to increase the return on equity, but this increase risk because the failure to make required debt payments yield many legal consequences, including bankruptcy. This is one reason why many top investors, such as Warren Buffett, focus on acquiring companies whose return on equity is derived primarily from operating activities. In the traditional DuPont analysis, return on equity is the product of the return on assets and financial leverage. Financial leverage is the ratio of total assets to stockholders' equity, which increases as the proportion of liabilities increases relative to equity. The problem is that the liabilities used in this computation include all the company's liabilities. However, there is a difference between borrowed money and operating liabilities, such as accounts payable and accrued liabilities. Accounts payable and accruals are interest-free and self-liquidating, meaning that they are paid when receivables are collected as part of the cash conversion cycle. On the other hand, borrowed money is interest-bearing and often contains severe legal repercussions in the event of non-payment, possibly risking bankruptcy. The operating focus treats these two types of liabilities differently for ROE analysis, treating borrowed money or debt as a non-operating item. Operating return can be measured by the return on net operating assets as shown on this slide. To implement this formula, we must first classify the balance sheet and income statement into operating and non-operating components so that we can assess each separately. This slide illustrates the operating and non-operating assets for Boston Scientific. Operating assets are those that are linked directly to the company's ongoing business operations of bringing its products or services to the market, which include accounts receivable, inventories, prepaid expenses and supplies, property, plant, and equipment, including both assets that are owned outright and those that are leased, intangible assets and goodwill, deferred income tax assets, and equity method investments, which are strategic investments with partners, associated companies, and joint ventures. Operating liabilities are liabilities that arise from operating revenues and expenses and include accounts payable, accrued expenses for wages and other operating expenses, unearned or deferred revenue, income taxes payable, both short and long term, deferred income tax liabilities, and pension and other post-employment obligations. Companies typically report other assets and liabilities both as current and long-term items. We assume that these are operating items unless information suggests otherwise. All balance sheets include non-operating liabilities and/or non-operating assets, although they are typically less numerous than the operating items. This slide shows the non-operating assets for Boston Scientific. Generally, non-operating refers to assets and liabilities that are not used as part of the core business activities of the company. Non-operating obligations include short-term and long-term debt, regardless of the purpose of the borrowing. Lease obligations, which are de facto debt liabilities tied to major capital equipment or other long-term assets. Interest payable, dividends payable, discontinued or held for sale liabilities, and derivative liabilities. Common non-operating assets include cash and cash equivalents, marketable securities, both current and non-current, discontinued or held for sale assets, and derivative assets. Net non-operating obligations is equal to the non-operating liabilities minus the non-operating assets. For most companies, net non-operating obligations is a positive amount, meaning that non-operating obligations are greater than non-operating assets. For an extensive list of non-operating and operating balance sheet and income statement accounts, refer to Appendix A of Module 3 in your text. In this learning objective, we identify income statement operating items and calculate net operating profit after tax. The income statement reports on both operating and non-operating activities. Operating activities are those that relate to bringing a company's products or services to market and any after-sales support. The income statement captures operating revenues and expenses, yielding operating profit. Operating profit less income tax on operating profit results in net operating profit after tax. This measure of a company's operating performance warrants special attention because it is the lifeblood of a company's value creation and growth. To more precisely analyze a company's operating activities, we separate the income statement into operating and non-operating activities as we did with the balance sheet. This slide shows the operating activity line items on the income statement. This slide shows Boston Scientific's operating and non-operating items on the income statement. Common non-operating items include interest expense on debt and lease obligations, loss or income relating to discontinued operations, debt issuance and retirement costs, interest and dividend income on non-strategic investments, marketable securities, gain or loss on the sale of non-strategic investments, and other income or expense if reported separately from operating income. The tax expense that companies report on their income statements pertains to both operating and non-operating activities. To compute net operating profit after tax, or NOPAT for short, we must compute the tax expenses relating solely to operating profit. The amount in parentheses is called the tax shield, which are the taxes that a company saves by having tax-deductible non-operating expenses. By definition, the taxes saved by the tax shield do not relate to operating profit. Thus, we must add back the tax shield to total tax expense to compute the tax on operating profit. It is important to note that for some companies with non-operating revenues and gains greater than non-operating expenses, the tax shield can be negative. A negative tax shield implies that the company is paying more tax than it would have paid if not for the additional non-operating income. We would add the negative tax shield to tax expense. This slide shows the calculation of Boston Scientific's net operating profit after tax. We start with the net operating profit before tax and subtract the tax expense or benefit per the income statement plus the tax shield to arrive at net operating profit after tax. In this case, Boston Scientific had a large tax benefit in 2018 due to the Tax Cuts and Jobs Act, which lowered the federal corporate income tax rate from 35% to 21%, as well as making other changes to the tax law that greatly benefited some companies. Many companies, including Boston Scientific, witnessed large swings in their overall tax bills in 2017 and 2018. The potential effect of the Tax Cut and Jobs Act on the income statement necessitates caution when we compare after-tax profits over years that include 2017 and 2018. In your textbook, a statutory tax rate of 22% is used, as this is approximately the average combined federal and state tax rate for public companies. An alternative method for calculating NOPAT is to add net income and net non-operating expenses after tax, which is called NNE. Ordinarily, this method should yield the same figure as the calculation above. In this learning objective, we will compute and interpret return on net operating assets. The return on net operating assets is calculated by dividing net operating profit after tax by average net operating assets, as shown on this slide. Boston Scientific's return on net operating assets for 2018 was 12.37% compared to the S&P 500 average return on net operating assets of 11.3% for the same year. The return on net operating assets for the S&P 500 has ranged from 9.3% to 12.5% over the period from 2014 to 2018. We can compare Boston Scientific's return on net operating assets with its ROA that we computed earlier. The return on net operating assets is higher, as shown on this slide, at 12.3% than the ROA at 8.35%. The numerator effect of RNOA focuses on NOPAT, which is $66 million higher than net income used in the DuPont ROA. The denominator effect in the return on net operating assets calculation was $14,038 million compared to return on assets of $20,021 million, which also pushed the RNOA higher. This slide shows the calculations of return on equity for Boston Scientific. Boston Scientific's ROE of 21.24% consists of an operating return of 12.37% and a non-operating return of 8.87%. Financial leverage relates to the degree to which the company uses borrowed money. While financial leverage increases risk, it also increases the return to shareholders, but only if the borrowing rate on the debt is less than the yield on the assets. Thinking again about the accounting equation, if assets are yielding 12% and the liabilities cost 10%, leverage is a positive force. However, if the assets continue to yield 12% but additional debt costs 13%, then leverage is a negative rather than a positive force. Comparing Boston Scientific's operating and non-operating returns, we can see that operating returns are contributing more to the ROE than non-operating returns. In this learning objective, we will disaggregate return on net operating assets into net operating profitability and net operating asset turnover. Similar to the components of ROA, we can disaggregate RNOA into net operating profit margin and net operating asset turnover to gain further insights into a company's performance. Net operating profit margin reveals how much operating profit the company makes from each sales dollar. All things equal, a higher net operating profit margin is preferable. Boston Scientific's net operating profit margin, as calculated on this slide, is at 17.68%. This result means that for each dollar of sales, a company earns about 18 cents in profit after all operating expenses and taxes. As a reference, the median net operating profit margin for the S&P 500 companies in 2018 was 12 cents. Net operating asset turnover measures the productivity of the company's net operating assets. This metric reveals the level of sales the company realizes for each dollar invested in operating assets. All things equal, a higher net operating asset turnover is preferable. Boston Scientific's net operating asset turnover ratio is calculated at 0.70 as shown on this slide. This result means that for every dollar of net operating assets, Boston Scientific realizes 70 cents in sales. As a reference, the median net operating asset turnover for S&P 500 companies in 2018 was 96 cents. Net operating profit margin is affected by the level of gross profit, operating expenses, and the level of competition. Companies can increase net operating asset turnover by either increasing sales for a given level of investment in operating assets or by reducing the amount of operating assets necessary to generate a dollar of sales, or both. Reducing operating working capital is usually easier than reducing long-term net operating assets. It is usually more difficult to reduce the level of long-term net operating assets. The level of property, plant, and equipment required by the company is determined more by the nature of the company's business model than by management action. However, there are some ways to reduce capital investment, such as working in corporate alliances, outsourcing, and the use of special purpose entities. Net operating profit margin and turnover of net operating assets are largely affected by a company's business model. This is an important point. Specifically, an infinite number of combinations of net operating profit margin and net operating asset turnover will yield a given return on net operating assets. This relationship is depicted in this graph, where the curved line reflects the median return on net operating assets of 13.7% in 2018 for the S&P 500 companies included in this graph. This exhibit reveals that for some industries such as railroads, oil and gas, exploration, and utilities that are capital intensive with relatively low net operating asset turnover. For such industries to achieve an adequate return on net operating assets, they must obtain a higher profit margin. On the other hand, companies such as automotive retailing, apparel, and household products companies hold fewer assets and therefore can operate on lower net operating profit margins to achieve an adequate RNOA. This exhibit also warns of blindly comparing the performance of companies across different industries. In this learning objective, we will briefly discuss computing and interpreting non-operating returns. As we mentioned earlier, return on equity is composed of operating return and non-operating return. In simple form, return on non-operating activities measures the extent to which a company is using debt to increase the return on equity. We can infer the non-operating return indirectly as the difference between the return on equity and the return on net operating assets. We can also compute the non-operating return directly, as shown on this slide, as equal to financial leverage times spread. Financial leverage is the level of net debt net of cash and investments relative to shareholders' investment. The spread is the difference between what operating assets earn and what the net debt cost. This means that return on equity can be disaggregated into return on net operating assets plus financial leverage times the spread. We see that the ratio definition of financial leverage here differs from the definition in the ROA disaggregation. The main distinction is that FLEV uses net non-operating obligations in the numerator instead of total assets. The slide shows the non-operating return definitions. This slide illustrates Boston Scientific's return on equity broken down into the return on net operating assets of 12.37% plus financial leverage of 0.784 times the spread of 11.3%. The slide shows the benefit of financial leverage to the non-operating return of Boston Scientific of 8.86%. About 35% of S&P 500 companies have negative non-operating obligations because non-operating assets exceed non-operating liabilities, which creates negative financial leverage. There are two reasons for this. One is that companies have experienced increased cash flows as a percentage of total revenues over the past decade, and companies have not repatriated foreign earnings to the U.S. in an attempt to avoid U.S. repatriation taxes. Amazon's ROE, as shown on this slide, is lower than its RNOA because of its large investment in marketable securities. That is, its excessive liquidity is reducing shareholder returns. Amazon's operating assets are providing an outstanding return of 40.46%, but overall ROE is much lower. In this case, return on net operating assets measures Amazon's operating performance much more accurately than ROA, showing that the operating approach is a critical and superior measure of Amazon's financial performance. In this learning objective, we will cover vertical and horizontal analysis. One of the benefits of ratio analysis is that it is unit-free, which means that ratios allow us to compare companies of different sizes and contrast financial statements reported in different currencies. We can augment our ROE disaggregated analysis of profitability, productivity, and leverage with two additional analyses: vertical and horizontal analysis. Companies come in all sizes, which presents difficulties when making comparisons among firms or between a firm and an industry benchmark or over time. There are several methods to attempt to overcome this obstacle. Vertical analysis expresses financial statements in ratio form. Specifically, we express income statement items as a percent of net sales and balance sheet items as a percent of total assets. Such common-size financial statements facilitate the comparison across companies of different sizes and comparisons of amounts within a set of financial statements. Horizontal analysis is the scrutiny of financial data over time. Comparing data across two or more consecutive periods assists in analyzing trends in company performance and in predicting future performance. The ratios we have calculated and discussed in this module provide a quantitative analysis of a wide range of financial metrics. However, the quality of such an analysis depends on the quality of financial information. We ought not blindly analyze numbers because doing so can lead to faulty conclusions and suboptimal decisions. Instead, we need to acknowledge that current accounting rules have limitations and be fully aware of the company's environment, the competitive pressures, and any structural and strategic changes. Some of the gap limitations include that the current accounting rules omit many assets, as we have discussed previously. Companies change over time through mergers and divestitures, which can significantly limit comparison between periods. Few companies are a pure play. Instead, most companies operate in several businesses or industries, and consolidated statements are challenging to analyze, which is one reason that companies are required to report segment information in their 10-Ks. Last, ratios reduce to a single number the myriad complexities of a company's operations. Ratios cannot meaningfully convey a company's marketing and management philosophies, its human resources activities, its financing activities, its strategic initiatives, and its product management. In our analysis, we must learn to look through the numbers and ratios to better understand the operational factors that drive financial results. And this is the end of Part 2 of the presentation for Module 3 for Accounting 311, Financial Statement Analysis for Global Entrepreneurs.